Hello, my name's Mark Jarvis and I'm a visiting professor at Manchester Metropolitan University. Welcome to the latest webinar in this series, which are recorded monthly, and in between these sessions there is a live meeting via Zoom with different participants, each time from the different sectors of the industry, SMEs, real estate. So to find out what's happening next and to join, please email cpe@mmu.ac.uk or keep an eye on my LinkedIn profile where I will post a link for you to register and join. So please keep an eye out. So these webinars were really inaugurated as a response to the business impact that the COVID-19 pandemic has had. So we have to start each time with a summary of where we are with the pandemic, and I think it's important to just have a look at the latest graphs. As you can see here from the screen I'm sharing, that the US is having difficulty keeping its cases under control. This is a graph that shows it's a comparative reset graph to back to the number of days since 10,000 cases were reached. It starts at 0 and it goes up from there. And as you can see here, the US is going in the wrong trajectory. I mean, you've probably seen this on the news, so it's not a surprise, but I think it's a very worrying concern for us all. The second wave is out there. We've seen this in Melbourne, in Australia this week, which is in lockdown again. Recently was in Beijing. So we have to keep a watch on this second wave. And whilst we are all, including myself, euphoric about being able to go to the pub again, that second wave is pretty sadly out there. So turning back to where we are, and the UK economy, of course, this week we've seen the Chancellor planning to invest vast sums in an attempt to minimise the long-term economic damage from the pandemic. Public borrowing will rise to more than £350 billion this financial year. So, with the Chancellor using his summer statement to outline a new package of job support, this is worth up to £30 billion. So the deficit is likely to reach some 18% of national income. This is almost twice the size of the deficit at its peak in the 2008-2009 global financial crisis. So Chancellor Sunak said in his speech to Parliament that this marked the moment that the UK could move from protecting the economy to supporting and creating jobs as the lockdown was lifted. So his new package took the total cost of the Treasury's economic support since March to about £189 billion. But with tax revenues hit hard by the crisis, the deficit is likely to reach some £260 billion plus. The Chancellor sought to limit the rise in employment with a series of measures that either subsidise jobs or encourage people to spend in the hardest hit sectors of the economy. The largest single item was the job retention bonus, which was £1,000 per worker paid to companies that bring staff back from furlough and keep them employed until January. This will cost some £9 billion, again, if everybody, 9 million on furlough, come back. The Treasury, as you know probably by now, will also cut VAT from 20 to 5 across the tourism and hospitality industry, including restaurants, pubs and cafes. We've highlighted on these seminars before that this is a particularly vulnerable sector, so this is good to see. The temporary cut will last for some 6 months and cost about £4 billion. Additionally, and it has got mixed press in the newspapers to help restaurants, Mr. Sunak announced a novel plan for Eat Out to Help Out, discounting 50% for meals and non-alcoholic drinks in cafes and restaurants during a short period in August. See, he also, I think this is a fundamentally important point, he raised stamp duty, a threshold on all home purchases in England and Northern Ireland from £125,000 to £500,000 until the end of March next year. This really is to help kickstart the struggling housing market. Another cost, £3.8 billion. So as billed before the statement, there will be a £2 billion Kickstarter work creation scheme to stop the UK's young people becoming part of what's being known as a blighted COVID-19 generation. Another big package, but the high cost demonstrated how hard it is to target the efforts and the resources to where it's really needed. Much of the job retention bonus would go to companies that would have rehired people anyway. Others worried that with the support being withdrawn towards the end of the year, the economic recovery from April's 25% slump in output will be stopped dead in its tracks. But Mr. Sunak insisted that the government's furlough scheme, which has supported 9 million jobs since March, has to end. The truth is, he said, calling for endless extensions to the furlough is just unfeasible. So I think he recognized that hardship does lie ahead. His statement was, no one will be left without hope. We are seeing all sectors being addressed, even the UK beauty industry, which contributes at a broad count some £20+ billion a year in its extended market. This includes nail salons, etc. Has finally got the go-ahead to open. So we are really seeing now everything coming back to normal, and Monday, even the nail salons will be open. So it's a great example, because I think carrying that on would have been a very decimated impact to the industry. So the Chancellor has been warned that he could need to revisit some of these more broad brush support for companies. Business groups such as the CBI are seeking extensions to some of the existing bailouts, such as the state-backed loans, business rate reliefs, etc., allowing companies to keep afloat and investing in their businesses. Carolyn Fairbairn, the CBI Director General, said that the job retention bonus would help companies protect jobs, but with nearly 70% of firms running low on cash and 3 in 4 reporting a lack of demand, more immediate direct support around firms generally is needed. And Mike Cherry, the chairman of the Federation of Small Business Unit, said the Chancellor was absolutely right to stress the job of getting the economy back on its feet, but it's only just begun. I think Mr. Sunak acknowledged that his autumn budget and spending review would be a bigger economic event as he attempts to rebuild the economy. But it is a start, and I think we have to be supportive for where he's going. However, the UK debt is now worth more than its economy. Quite a startling headline after the government borrowed this record amount in May. The £55.2 billion pound figure was 9 times higher than in May last year, and the highest since records began in 1993. So the borrowing splurge has sent total government debt surging to £1.95 trillion, exceeding the size of the economy for the first time in more than 50 years. And if I may share a screen with you, just to look at the size of the borrowing per month over the past year, you can see just how huge the April-May figures are compared to what we've been used to for the past few years. The Chancellor confirmed that the severe impact was having on public finances, and said the best way to restore our public finances to a more sustainable footing is to safely reopen our economy, and I think we know that, but what we can see with these figures is that this is the first time, as I said earlier, that the debt has been larger than the size of the economy. And if I show you this graph here, here we go back, and you can see around the war and the impact of debt as a percentage of GDP. And since then, and since '63, we've seen debt as a percentage of GDP severely falling. We saw the pickup in 2008, 2009 financial crisis, and now we are back to over 100%. Something to think about there, as you know, he has to do what he has to do. There's no question about that, but the impacts are going to be along with us for many, many, many years. Perhaps in more detail, as we're talking about finance consequences of the COVID-19 pandemic, the deficit, the difference between spending and tax income for the first 2 months of the financial year is now estimated to have been £103 billion. Again, £87 billion more than last year. The Office of National Statistics estimates borrowing for 2020-21 financial year will dwarf that at nearly £300 billion. So that would be the largest deficit, as we just saw from that graph, since World War II. It's cautioned that due to the coronavirus, these estimates are very uncertain, and they could be up or down on those figures. Of course, the impact of the retention scheme could end up being lower than originally estimated, but certainly some severe impacts. I think if we look broadly at the economy, a senior economist at PwC, PricewaterhouseCoopers, pointed to the 46% fall in VAT receipts in the recent month. It's the biggest issue for the government finances was, of course, the 29 billion it spent on various support schemes, but the lack of income is significant. In the near term, there are signs the economy is recovering, perhaps quicker than we expected as the company reopens, and this should back tax receipts. However, these figures remind us that the Chancellor faces a difficult backdrop to any summer fiscal event. It's without doubt that the emergency support measures has placed a colossal burden on public finances. So busting the overdraft with a borrowing figure 9 times as high as a year ago is not an easy thing for any government to swallow, of course. It's the first full year Chancellor Rishi Sunak is on track for the biggest public sector deficit since World War II. But hopefully it's a price worth paying to prevent a bigger cost to the economy. Certainly in terms of jobs loss and output, billions have been pumped in supporting millions of jobs and many businesses, while on the other side, tax receipts have plunged. So those lifelines will be wound down in the coming months, and we hope that the government can borrow cheaply on financial markets to fund those. What happens next? As lockdown is eased, the Treasury is watching closely, I think, knowing that recovery may need extra support. Perhaps tax cuts or more spending. As I said, we've seen the VAT cuts this week. That will present the government with more bills, but failing to provide more help risks, I think, an even higher costs. A brief look at shares while we're here, and the gold market has shown how that nervousness is continuing globally as stocks continue to waver, as the coronavirus, the secondary outbreaks we talked about earlier, threatened recovery, and gold is hovering at a near 9-year high. Wall Street is swinging between gains and losses. Global stocks retreated this Wednesday, while gold tested at a 9-year high as investors tracked a surge in coronavirus cases that threatened to undermine the economic recoveries across the world. US shares swung between gains and losses, with the S&P 500 little changed by midweek in New York, but European equity benchmarks slipped quite a bit. This cautious tone, I think, has followed the Texas, California, and Florida reporting a big increase in coronavirus outbreak. US infections, as we talked at the beginning of this session, has risen significantly, and the number of deaths has jumped to levels not seen since June. Gold, of course, the safe haven for investors, was a beneficiary, with spot prices hitting their highest levels since 2011. Metals often considered this safe haven in times of market turmoil, and rose to trade above $1,800 a troy ounce. So yields on 10-year US and UK government bonds held steady, and sterling was largely unmoved against the dollar. So reiterating, gold is the more attractive defense position, especially with government yields being as low as they are. Oil, the per barrel prices of Brent, the international market maker, and the US benchmark West Texas Intermediate barely changed at around $43 to $40. China's Shanghai and Shenzhen listed stocks closed up 1.6%. So actually, strangely enough, that small increase puts mainland Chinese stocks, despite all the news about Hong Kong, on course for its biggest weekly advance since December 2014. Touching on corporate strategic activity, as we moved into the second half of 2020, we do see a significant pickup in corporate strategic activity, particularly in sectors like technology and healthcare. Deal activity has been incredibly low during this period of volatility, but there's a pent-up demand. We do think there's a substantial capital on the sidelines, and there are industries in real need of consolidation as we see fallout coming from the less robust companies. Also, and with a hopeful slant after decades of driving companies to maximize shareholder values as a key focus, there's been a little bit of a pivot towards trying to understand social purpose. Whilst I'm quite sure capitalism will endure, there does seem to be an equally slight pivot away from the shareholder value primacy, and at least a degree of social purpose, and hopefully that will be a lasting impact rather than a short-term fad. So turning back to the UK, a question that's been asked is, could COVID fix Britain's productivity problem? Well, the contagious nature of the COVID-19 disease and the absence of any cure means that all predictions could turn downwards if countries go back into lockdown. It's also true that through these indicators, support for the notion of a V-shaped recovery, which we've talked about many times on these webinars, says it's still out there to be discussed. There is one specific aspect that sits oddly with all this, and this is the persistent emptiness of our city centres. The central London, for example, is super quiet. This is down to the work from home put in place by companies that dominate the central London office space. But there are plenty signs that for many countries, this could be a new permanent way of life. It might suit a lot of their employees to work that way, and it also saves the companies a huge amount of rent. Until there's a vaccine, we won't know what attitudes will prevail, especially among younger workers who tend to share flats. Many of them could be eager to get back to the office. But what seems clear is that if many large office-based employers don't return to their past ways, then it will be exceptionally difficult for large swathes of the service support economy, such as takeaways, cafes, pubs, many restaurants and so on, to survive. And this is not even taking the world of live music, theatre, business travel into consideration. So the question, I think, is how can a V remain a V-shaped recovery for the next few months? Other parallel shifts are taking place. Just as central London and probably elsewhere, the economy is struggling. The suburban economy, however, is booming with all these office workers successfully functioning from home. Their local services are thriving, and it could be that this turns out to be the more productive model, as all that time commuting is time saved for more productivity or more leisure. Dare I suggest that the possibility this might be the beginnings of the productivity upturn that has evaded us for so long, despite all the technological advantages of this modern world. The same goes for business travel. Perhaps this pandemic means excuse me, a lot of people will simply not travel to vast distances for meetings that could have been done via Zoom all along. It will hurt some airlines for sure, and some aviation manufacturers, and some meeting room providers too, but not overall our productivity. So as for personal travel, judging from the noises coming out of travel operators, despite all the rest, a lot of people are booking foreign holidays. It really is impossible to know whether these shifts are permanent or not. Only when we have a vaccine will the scale of the changes become clear. But maybe, just maybe, we are letting a crisis go to waste. I'm Mark Jarvis, and it's been a pleasure to talk to you this afternoon.